Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Healthpeak Properties, Inc. annual report. Healthpeak Properties, Inc. is a leading healthcare-focused real estate investment company that owns, operates, and develops high-quality properties across the United States. The company's diversified portfolio consists of three core asset classes: outpatient medical, lab, and continuing care retirement community, CCRC, real estate. The outpatient medical segment includes ownership and operation of outpatient medical buildings, hospitals, and lab buildings. This segment comprises 530 properties in Healthpeak's portfolio. The lab segment consists of 139 properties, including lab buildings. The CCRC segment is operated through RIDEA structures and comprises 15 properties. In addition to these core segments, the company has other non-reportable segments that include an interest in an unconsolidated joint venture owning 19 senior housing assets, loans receivable, and a preferred equity investment. These segments are presented on a combined basis and consist of 19 properties. Healthpeak's portfolio also includes interests in certain unconsolidated joint ventures, totaling 703 properties across the United States. The company is headquartered in Denver, Colorado, with additional corporate offices in California, Tennessee, Wisconsin, and Massachusetts, as well as property management offices throughout the country. Healthpeak Properties, Inc.'s stock price has experienced significant declines in the past year, exceeding 11.7%. The main contributors to this drop include a substantial earnings miss in its third quarter of 2025, a downgrade from analysts, and challenging market conditions in the life science segment. The company's third-quarter earnings report was particularly disappointing, with an EPS of -$1.17, far below the expected $0.586. This significant miss led to a negative surprise of 390.1%. Analysts also downgraded Healthpeak Properties from buy to hold, citing concerns about weak laboratory market fundamentals and high vacancy rates. The life science operating environment was characterized as historically challenging by management, with operating intensity peaking in the first half of 2025 and impacting earnings. Furthermore, the company's adjusted funds from operations, FFO, guidance for 2026 was lowered due to lab occupancy losses and a $0.12 earnings impact from lost base rent, increased operating expense exposure, and releasing capital. Additionally, Healthpeak Properties faced refinancing headwinds at higher interest rates, including a $150 million loan at approximately a 10% interest rate, which further contributed to the stock's decline. These events led to new 52-week lows for the company, with a reported decline of 18.44% over the year by December 19, 2025, and an 18.02% decline by December 9, 2025. Healthpeak Properties, Inc. maintains a market capitalization of $11 billion, broadly in line with the industry peer group. Healthpeak Properties, Inc. trades at a higher price-to-earnings ratio of 164 times and a lower price-to-book ratio of 1.52 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.42%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the key points related to revenue growth and decline. On one hand, the outpatient medical segment experienced a significant 8% increase in revenue from 2024 to 2025, while the senior housing segment saw a notable 6% growth during the same period. Additionally, non-refundable entrance fees increased by $53,805,000, indicating a substantial contribution to revenue growth. On the other hand, the lab segment and senior housing segment experienced declines in revenue, with the lab segment decreasing by 2% and the senior housing segment experiencing an $11,475,000 decline. These decreases were partially offset by increases in non-refundable entrance fees and acquisition of real estate and development improvements. Geographically, California, Florida, Texas, Massachusetts, HCA Healthcare, Inc., and CommonSpirit contributed significantly to total revenues, with California accounting for 23% of the total. The presence of these significant revenue contributors suggests that regional market conditions may play a crucial role in driving revenue growth or decline. Net income decline, a shift in profitability. The net income of the company has experienced a significant decline over the past few years. In 2024, it stood at $242.38 million, but by 2025, it had dropped to $70.51 million. This decrease is also evident when comparing the net income for 2023 and 2025, which shows a drop from $334,757,000 to $101,027,000. The decline in profit margins further emphasizes this trend. While not directly stated on all pages, it can be inferred that there has been a significant decrease in profit margins due to the decline in net income compared to previous years. Specifically, the profit margin decreased from 12.7% in 2024 to 0.9% in 2023, and from 9.93% in 2024 to 3.58% in 2025. Several factors have contributed to this change in profitability. The loss on sales of real estate has had a significant impact, as well as the decrease in accounts receivable and other assets. Additionally, government grant income played a substantial role in 2023, accounting for $413,000 out of an unknown total. Furthermore, the capitalization of direct construction and development costs has also affected profitability, including pre-development costs, interest, property taxes, insurance, and other related expenses. These factors have collectively contributed to the decline in net income and profit margins over the past few years. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the provided information, the company has consistently produced positive operating cash flow over the past 3 years. This is evident in the net cash provided by operating activities, which has been $1,251,959,000 or more for each year. The consistent generation of positive operating cash flow suggests that the company's business model is profitable and capable of producing sufficient cash to meet its financial obligations. The company's debt level has undergone significant changes over the past few years. Initially, the total debt as of December 31, 2025 was approximately $9.8 billion, a notable increase from the previous year. Furthermore, the bank line of credit and commercial paper increased substantially, rising from $150 million to $1.078 billion. This substantial growth in debt is also reflected in the total debt level, which increased from $4,311,250 in 2023 to $12,121,070 in 2025. In terms of interest expenses, there has been a notable increase as well. The interest expense rose by $24,748,000 and continued to grow, increasing by $10,638, 4.2% increase, from 2023 to 2024, and then by $12,638, 6.7% increase, from 2024 to 2025. This indicates a steady rise in interest expenses over the years, which may be attributed to the increased debt level of the company. The performance of various segments and regions within HCA Healthcare, Inc. has been mixed. On the positive side, the outpatient medical segment has shown strength, accounting for a significant portion of revenues. In contrast, the lab segment appears to be struggling due to decreased demand from biotech and life science companies. Several regions have also underperformed. Senior housing, in particular, lacks performance metrics, making it difficult to assess its current state. Texas has seen a decline in its share of gross real estate assets and revenues, decreasing from 11% to 10%. Florida's revenue share has remained stable at 17%, but its overall contribution has decreased slightly. The lab segment is the most concerning area, with potential issues arising from industry consolidation and the migration of life science companies. This trend may have a lasting impact on HCA Healthcare, Inc.'s performance in this sector. The company's management is optimistic about its outlook and strategy. The key areas of focus include acquiring and developing real estate investments in outpatient medical buildings and lab spaces, which will drive growth and increase revenue. To mitigate potential risks, the company is actively managing interest rate risk through the use of derivative instruments. In addition to expanding its portfolio, the company is also prioritizing debt reduction by making early repayments on mortgage debt and senior unsecured notes. This strategic move will not only reduce financial obligations, but also improve the company's overall financial health. Management believes that FFO as adjusted and AFFO provide meaningful supplemental measures of the company's performance, which are frequently used by analysts and investors to evaluate its success as a REIT. The company is committed to maintaining its REIT status and continues to focus on managing cash flow effectively. Overall, the company's strategy appears to be centered around strategic growth, risk management, and financial discipline. By executing these plans, management is confident that the company will continue to thrive and achieve its goals. Acquisitions and divestitures overview. The company has made several strategic moves through acquisitions and divestitures. On page 64, the company acquired the remaining 50% interest in the Gateway Crossing JV for $132 million in January 2026. This acquisition demonstrates the company's commitment to expanding its portfolio through joint ventures. In addition to this significant acquisition, the company has also made other notable moves. For instance, on page 23, it is mentioned that the company will develop, acquire, and or recapitalize properties in joint ventures with other entities. This suggests a proactive approach to growth through strategic partnerships. On the divestiture side, the company has disposed of senior housing facilities without providing specific details, page 27. Furthermore, on page 66, it is noted that Physicians Partnership was merged into Healthpeak OP, and its senior unsecured notes were assumed by Healthpeak as part of the merger. This indicates a strategic decision to consolidate assets and streamline operations. Overall, these acquisitions and divestitures reflect the company's efforts to optimize its portfolio, expand through joint ventures, and streamline its operations. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends on a quarterly basis, starting from April 2025. This indicates that the company values its shareholders and is committed to providing them with regular returns on their investment. In addition to paying dividends, the company has also been actively buying back shares. In 2024, it approved a share repurchase program worth up to $500 million, which demonstrates its confidence in the company's future prospects and its desire to return value to shareholders. The company has successfully executed this program by repurchasing 10.5 million shares at an average price of $17.98 per share, totaling $188 million. That concludes the financial summary for Healthpeak Properties, Inc. Feel free to comment below, and I will be happy to answer them when possible.